Let's jump right into this explainer and decode a real mystery that honestly defines the future of value investing. We're going to look at Berkshire Hathaway's perceived, inaction during the 2023 banking crisis. But more importantly, we're going to see how navigating all that chaos perfectly frames 2026 banking mastery and the monumental leadership transition currently underway at this absolute financial giant. Let's find out how a titan actually prepares for the future. So, the million-dollar question, or maybe billion-dollar question, sparked by astute market observers is this. Why didn't Warren Buffett swoop in to save struggling institutions like Silicon Valley Bank and First Republic? If you think back to the 2008 financial crisis, Buffett famously stepped in, practically bailing out major financial institutions. And he did it with way less cash on hand than he had in 2023. But when these regional banks were collapsing and desperately seeking a white knight, Berkshire was just silent. Did they simply chicken out? Well, to answer that, we really have to look past the surface-level panic. Moving right into Section 1, the trillion-dollar problem, managing the Mastodon. To truly understand this silence, we first need to look at an unprecedented macroeconomic hurdle Berkshire Hathaway is facing today. It's a problem almost no other company on Earth deals with. Berkshire's current reality is that they've become what we can call a corporate mastodon. They have literally outgrown traditional investment maneuvers. For a regular corporate entity making a few $100 million acquisition, that's just Tuesday. But for Berkshire, almost any move they make instantly shifts the entire market. They're tied to millions of retirement accounts and major funds, so when they move, everybody watches and everybody reacts, which makes aggressive, stealthy moves practically impossible. And to put a number on that mastodon, they are sitting on an astonishing $380 billion in cash. Let that sink in. That is roughly the GDP of a small country, just sitting in the bank. Now, having more money than you can discreetly deploy sounds like an incredibly enviable position, right? And yeah, for sure it is. But as the investing community rightly points out, it is a surprisingly difficult responsibility. It dramatically limits your target pool. You can't just buy small cap companies anymore. They simply don't move the needle when you're a trillion-dollar mastodon. Which brings us to Section 2, navigating banking black holes. Let's see how this immense size, combined with their strict investment philosophy, explains why those 2023 troubled banks didn't meet Berkshire's criteria for a bailout. There's a stark difference here that a lot of casual observers totally miss. In 2008, Berkshire intervened with strong franchises like Goldman Sachs. Goldman didn't really have a fatal financial flaw. They had a confidence and reputational issue during a massive market panic. Buffett gave them a huge vote of confidence and, in return, scored fantastic investment terms. The 2023 crisis? Completely different beast. Banks like Silicon Valley Bank had invisible liabilities and severe structural issues. We're talking basic fundamental banking errors, like mismatching short-term liabilities with long-term assets. In the eyes of value investors, these weren't deep discounts. They were black holes. But here's the real plot twist that completely changes the narrative, and it's something almost everyone overlooks. The legal barrier. Berkshire is actually legally blocked from buying these troubled banks outright. Yep, because of their massive, sprawling insurance empire, especially with recent investments in companies like Chubb, regulatory laws prohibit them from taking outright ownership of a bank. Doing so would create a regulatory headache of truly epic proportions. So stepping in to acquire SVB entirely wasn't just financially unappealing, it was a literal legal non-starter. Let's transition to Section 3, protecting the Buffett legacy. With regional banks off the table, let's examine the deeply human element of this corporate transition. Because Berkshire Hathaway isn't just a spreadsheet, right? It's made up of people managing a legendary reputation. As one astute observer from the value investing community noted, we really have to look at the leadership shift. Warren Buffett is approaching 100 years old. The new CEO, Greg Abel, has taken over the day-to-day management with a clear eye toward 2026 and beyond. Think about it. When you step into the shoes of the most famous investor in history, you are purposefully going to be cautious. Abel wants to protect that legendary track record from unforced errors. The absolute last thing you want for your opening act as CEO is to be caught catching a falling knife in a regional banking crisis. It's a massive, massive responsibility. The mandate passed down is all about maintaining extreme discipline, rather than chasing risky, headline-grabbing bailouts. Berkshire didn't build its wealth by trying to double its money on every single market turn, or by swooping in to save every failing fifth-tier financial institution. They built it on shrewd, highly disciplined asset management, and that is exactly the legacy Abel is tasked to honor. This naturally leads us to Section 4, waiting for the right pitch.
This is the core philosophy guiding Berkshire's massive $380 billion cash pile today, and it boils down to extreme patience. They use this legendary rate pitch strategy, which is basically a classic baseball analogy. Berkshire doesn't look at hundreds of billions of dollars as an excuse to take more risks. Nope, they treat $1 exactly the same as $300 billion. They actively avoid value traps, those assets that look super cheap but are cheap for a very good reason, usually harboring nasty hidden liabilities. They demand sound fundamentals. In their view, investing isn't a game where you get called out on strikes just for looking. It is infinitely better to not swing at all than to swing at a bad pitch and completely miss. They are simply waiting for the pitch they absolutely know they can hit out of the park.
All right, Section 5, Finding Value in New Sectors. So, if regional banks aren't the right pitch, where is the value investing community actually looking for opportunities today? What sectors are presenting that perfect fundamental alignment? Well, cutting through all the market noise, we can see where investors are finding actual, tangible value. In AI-adjacent tech, it's not just about flashy new startups, it's about foundational infrastructure. The community heavily points to Microsoft as the chassis for the AI engine, alongside strong cash flow generators like Uber and Mercado Libre. Over in healthcare, Novo Nordisk is catching a lot of attention as a world-class business currently trading at a discount following some recent sell-offs. And looking at industrials, companies like Fluor are highly favored for their de-risked roles in physically building the data centers that will power our future. Even in niche markets, there's a surprisingly strong case for gold miners operating at low forward earnings, or satellite communication plays like AST Space Mobile, locking in massive telecom clients. However, as exciting as those sectors are, the community also issues a pretty stark warning. You've got to be incredibly vigilant. Beware of online bag holders. People loudly pumping specific ticker symbols without any real fundamental analysis, just because they're personally trapped in a bad investment. You have to constantly ask yourself, is this stock truly undervalued, or is it a value trap that's cheap simply because the underlying business is falling apart? The real key to long-term mastery is having the clarity to distinguish between a wildly speculative bet and true fundamental value investing. Which leaves us with this final, incredibly provocative thought to wrap up our explainer today. As we look toward 2026 and this wild new paradigm of rapid AI development, unprecedented monetary policy, and constantly shifting PE ratios, we really have to ask, did Warren Buffett simply miss the boat on modern tech? Or is the smartest, most sophisticated move in the entire room simply having the ironclad discipline to patiently wait for the absolute perfect pitch? Thank you so much for exploring this with me today. Honestly, it's a question every single investor needs to answer for themselves.